Right now, as you're watching this video, something extraordinary is happening in the silver market that most people have no idea about. While everyone's been distracted by Bitcoin hitting new highs and the stock market's wild swings, a quiet revolution has been building in the precious metals space. And the smart money, the people I call the silver stackers, they've been positioning themselves for what's coming next. I'm talking about people who've been accumulating physical silver for months, even years, while the price has been suppressed. They're not just buying a few coins here and there. They're backing up trucks. They're converting entire portfolios. They're moving retirement accounts. And they're doing it all while maintaining complete radio silence about their strategy. Why the secrecy? Because they understand something that the mainstream financial media refuses to acknowledge. We're not just looking at another precious metals bull run. We're staring down the barrel of the most significant supply crisis in silver's modern history, combined with an explosion in industrial demand that's about to collide with decades of market manipulation finally unwinding. Let me paint you a picture of what's really happening behind the scenes. Last month, I had a conversation with a dealer in Texas who's been in the precious metals business for 30 years. He told me something that sent chills down my spine. He said, "In all my years doing this, I've never seen anything like what's happening right now. The big buyers aren't just coming in for their usual positions. They're liquidating everything else to get into silver. And they're not talking about it." This dealer showed me his order books. Names I can't mention. Family offices, hedge funds, even some sovereign wealth funds, placing orders for physical silver that would have been unthinkable just 2 years ago. We're talking about single orders for millions of ounces. Not paper silver, not ETFs. Physical metal that they're taking delivery of and storing in private vaults. But here's where it gets really interesting. These aren't your typical precious metals investors. These are people who've made fortunes in tech, in real estate, in traditional markets. They're diversifying into silver, not because they love shiny objects, but because their analysts have run the numbers on what's coming. And those numbers are absolutely staggering. The first piece of this puzzle is industrial demand, and it's unlike anything we've ever seen before. Silver isn't just a monetary metal anymore. It's become the backbone of the green energy revolution, and most people have no idea how much silver these new technologies actually consume. Take solar panels, for example. Every single solar panel requires about 1 ounce of silver. Sounds manageable, right? But here's what the mainstream media isn't telling you. The International Energy Agency projects that solar capacity needs to increase by 85% annually through 2030 to meet climate goals. That's not a typo. 85%. Every single year. Do the math with me for a second. If we're installing solar panels at that rate, we're talking about consuming roughly 200 million ounces of silver annually just for solar by 2030. That's nearly a quarter of total global silver production. And that's just solar. We haven't even talked about electric vehicles, 5G infrastructure, or the dozens of other technologies that are becoming silver dependent. But here's where the story gets really wild. A contact of mine who works for one of the major silver mining companies, and I can't name the company because he'd lose his job, told me something that should terrify anyone who doesn't own physical silver. He said the mining industry has a dirty little secret they don't want investors to know about. Most of the world's silver doesn't come from silver mines. It comes as a byproduct of copper, lead, and zinc mining. About 70% of silver production is secondary to other metals. So when those base metal mines become unprofitable or shut down for environmental reasons, silver production collapses right along with them. And guess what's been happening over the past 2 years? Base metal mining has been under assault from environmental regulations, energy costs, and supply chain disruptions. Mines that were profitable at $20 copper are barely breaking even at $25. Some are shutting down entirely. And when they shut down, that silver production disappears. My mining contact showed me internal projections that suggest silver production could drop by 15–20% over the next 3 years, just from mine closures and reduced output. Meanwhile, industrial demand is exploding. You don't need to be a mathematician to see where this is heading. But the supply crisis goes even deeper than mining. There's something happening in the silver market that most people don't understand, and it has to do with above-ground inventories. For decades, governments and institutions held massive silver stockpiles. The U.S. government alone used to hold over 2 billion ounces. Today, that number is essentially zero. Where did all that silver go? It got consumed. Unlike gold, which gets hoarded and recycled, silver gets used up in industrial applications. When silver goes into a solar panel or an electronic device, it's gone forever. It's economically impossible to recover. So for the past 50 years, we've been eating through above-ground silver stockpiles to meet industrial demand. A researcher I know who tracks precious metals inventories told me something that should wake up every investor. He said, "We're approaching the point where annual silver production won't be able to meet annual demand, even without any investment demand. And when investment demand kicks in, which it always does during monetary crises, we're looking at shortages that could make the 1970s look like a warm-up act." Speaking of monetary crises, let's talk about what's happening in the currency markets, because this is where the silver stackers are really showing their intelligence. They're not just betting on industrial demand, they're positioning for the inevitable collapse of confidence in fiat currencies. Look at what's happening with the dollar right now. The Federal Reserve has printed more money in the past 4 years than in the previous century combined. The national debt is approaching $35 trillion and growing by $1 trillion every 100 days. Meanwhile, countries around the world are actively working to reduce their dependence on the dollar. China and Russia have been accumulating gold at record pace, but here's what most people don't know. They've also been quietly accumulating silver. Not through official channels that get reported in the news, but through state-owned enterprises and proxy buyers. Why? Because they understand that silver is gold's little brother, and when confidence in paper currencies collapses, both metals are going to explode higher. But there's another angle to this story that the silver stackers have figured out, and it has to do with market manipulation. For years, the silver market has been suppressed through paper trading on the COMEX. Banks and institutions have been selling massive amounts of paper silver that doesn't actually exist, to keep the price artificially low. This manipulation has been documented in court cases, regulatory fines, and whistleblower testimonies. J.P. Morgan alone paid nearly $1 billion in fines for manipulating the precious metals markets. But here's the thing about manipulation. It can only last so long before physical reality reasserts itself. And that's exactly what's starting to happen. The gap between paper silver prices and physical silver availability is widening every month. Dealers are reporting premiums of $5 to $8 per ounce over spot price, and delivery times that have stretched from days to weeks to months in some cases. I spoke with a dealer in California who told me he had a customer try to buy 10,000 ounces of Silver Eagles last month. The customer was willing to pay full premium, cash on delivery. The dealer had to tell him it would take 4 months to fulfill the order. 4 months. For a metal that's supposedly abundant and cheap. This is what the silver stackers have been preparing for. They've been accumulating physical metal while it's still available, while the premiums are still reasonable, and while the manipulation is still holding prices down. They know that when the paper market finally breaks, and it will break, there's going to be a mad scramble for physical metal, and most people are going to be left empty-handed. Now, if you're sitting on $100,000 or more in retirement accounts, there's something you should know about protecting that wealth. I've put together a comprehensive guide on how gold IRAs work. It's linked in the description below. This covers how you can get physical precious metals into your retirement account without tax penalties, and it might be worth checking out if wealth preservation is important to you. But let's get back to what the smart money is doing, because there's another layer to this story that most people miss entirely. The silver stackers aren't just buying silver as an inflation hedge or a currency collapse play. They're positioning for what I call the industrial squeeze, a scenario where silver becomes so critical to technological infrastructure that governments and corporations will pay any price to secure supply. Think about it this way. If you're Tesla, and you need silver for your electric vehicle production, and there's a shortage, what do? You pay whatever it takes to get the silver, because without it, your entire production line shuts down. The same goes for solar panel manufacturers, electronics companies, and defense contractors. This creates what economists call inelastic demand. Demand that doesn't decrease even when prices rise dramatically. And when you combine inelastic industrial demand with investment demand during a monetary crisis, you get price explosions that defy all conventional analysis. History gives us some clues about what this might look like. In 1979 to 1980, silver went from $6 to $50 in less than 2 years. But that was purely an investment-driven bubble created by the Hunt brothers trying to corner the market. What we're facing now is fundamentally different. This time, the demand is real, structural, and growing exponentially. A quantitative analyst I know ran some models on what silver prices might look like if industrial demand continues growing at current rates while supply remains constrained. His conservative estimate, and I stress conservative, puts silver at $100–150 per ounce within 5 years. His aggressive scenario, which factors in monetary crisis and investment demand, puts silver at $300–500 per ounce. Now, I'm not saying those numbers are guaranteed. Markets are unpredictable, and there are always factors we can't foresee. But what I am saying is that the risk-reward profile for silver right now is unlike anything we've seen in decades. The downside is limited. Silver has industrial value that provides a floor, but the upside potential is enormous. The silver stackers understand this asymmetric risk profile, and they're positioning accordingly. They're not trying to time the market or catch the exact bottom. They're accumulating systematically, month after month, building positions that will benefit from any of several different scenarios playing out. But there's something else these sophisticated investors are doing that most people miss. They're not just buying silver, they're buying the right kind of silver. There's a huge difference between owning shares in a silver ETF and owning physical silver coins in your possession. When you own an ETF, you own a piece of paper that says you own silver. But do you actually own silver? Can you take delivery? Can you hold it in your hand? In most cases, the answer is no. And in a real crisis, the kind of crisis that drives people to precious metals in the first place, that piece of paper might not be worth much. The silver stackers are buying physical metal. Silver eagles, silver maples, silver bars. Metal they can hold, store, and control. They're not trusting their wealth to financial institutions or paper promises. They're taking physical possession, because they understand that in a real crisis, possession is 9/10 of the law. This brings up another critical point that most investors don't consider: storage and security. The silver stackers aren't just buying metal and stuffing it under their mattresses. They're thinking strategically about storage, about security, about accessibility. Some are using private vaults, others are diversifying storage locations, and many are keeping some metal easily accessible for emergency situations. There's also a psychological element to this that's worth understanding. When you own physical silver, you own something real, something tangible, something that has held value for thousands of years. In a world of digital assets and paper promises, there's something profoundly reassuring about holding real money in your hands. But perhaps most importantly, the silver stackers are preparing for optionality. They're not betting everything on one specific outcome. They're positioning themselves to benefit from multiple scenarios: inflation, deflation, currency crisis, industrial shortage, or simply a return to historical gold-silver ratios. Speaking of gold-silver ratios, this is another angle that sophisticated investors are watching closely. Historically, silver has traded at about 15 to 20 ounces of silver per ounce of gold. Today, that ratio is around 80 to 1, meaning silver is historically cheap relative to gold. When this ratio reverts to historical norms, and it always does eventually, silver outperforms gold dramatically. In the 1970s bull market, gold went up about 24 times, but silver went up 38 times. The silver stackers are positioning for a similar reversion, and they're using the current ratio as a buying opportunity. There's also a generational wealth transfer happening that's flying under the radar. Baby boomers who accumulated wealth in traditional assets are starting to diversify into hard assets as they approach or enter retirement. Meanwhile, younger investors who've grown up with digital currencies and alternative investments are increasingly interested in physical precious metals as a hedge against systemic risk. This creates a unique dynamic where both older and younger investors are converging on silver for different reasons, but with the same ultimate goal: preserving and growing wealth outside the traditional financial system. The silver stackers I've spoken with aren't just thinking about the next year or two. They're thinking generationally. They're building positions that they can pass down to their children and grandchildren. They understand that silver isn't just an investment. It's a store of value that transcends political systems, currency regimes, and economic cycles. But here's what really separates the silver stackers from casual precious metals investors. They're educated. They understand the market dynamics, the supply and demand fundamentals, the monetary policy implications, and the technological trends. They're not buying silver because someone on YouTube told them to. They're buying because they've done their homework and reached their own conclusions. And their conclusions are remarkably consistent. Across different backgrounds, different investment philosophies, and different risk tolerances, they're all reaching the same basic conclusion. Silver is dramatically undervalued relative to its future importance in the global economy. So the question becomes, should you be preparing for what the silver stackers are preparing for? Should you be positioning yourself for a potential silver shortage, a currency crisis, or a technological revolution that makes silver indispensable? I can't answer that question for you. Everyone's financial situation is different, and everyone has different risk tolerances and investment goals. But I can tell you this. The silver stackers aren't gambling. They're not speculating on get-rich-quick schemes. They're making calculated, strategic decisions based on fundamental analysis of supply, demand, and monetary trends. They're preparing for a future where physical assets matter more than paper assets, where real money outperforms fake money, and where being positioned ahead of the crowd makes all the difference between financial security and financial devastation. The window for positioning yourself alongside the silver stackers is still open, but it's closing rapidly. Every month that passes, physical silver becomes harder to find, more expensive to buy, and more critical to the global economy. The smart money is moving now, while most people are still distracted by other investments. The choice is yours. You can wait and see what happens, hoping that the current monetary system holds together and that technological demand for silver somehow gets met by increased supply. Or, you can follow the lead of the silver stackers and position yourself for what they believe is inevitable, a fundamental repricing of silver that reflects its true value in the modern economy. Whatever you decide, don't say you weren't warned. The silver stackers have been quietly preparing for months, building positions while the getting was good. They understand that in markets, timing isn't everything, but positioning is. And right now, while silver remains historically undervalued and physically available, the positioning opportunity of a lifetime is staring us all in the face. The question isn't whether something big is coming to the silver market. The question is whether you'll be ready when it arrives.